that was probably one of the things I was most proud of at that company. Well, it was a search engine for jobs. And so you could do anything you want with sort of providing error messages, unusual, approach to sort of building a search engine that would sort of provide funny error message responses.
Superclusters is where we demystify the secrets, stories, and tactics behind the money that moves the venture capital world. What's up, Superclusters fans? Today we are in for a treat. And this is actually the first time we are covering a topic that we haven't covered before on Superclusters, which is fund secondaries. And I can't imagine a better person to ask than Dave McClure. Dave McClure is the founder and managing partner of Practical Venture Capital, a micro VC secondary firm aimed at providing liquidity for both LPs and GPs of early stage venture funds alike. He is an active LP in a number of emerging managers, including one where we're co-investors in. You might be familiar with his work at 500 Startups, now 500 Global, as well as 42 Geeks. He's an early member of the PayPal Mafia and first broke into venture capital across a suite of roles at Founders Fund and the Facebook Fund. We've got a lot to cover today, and you'll realize pretty quickly on how much of this is above my pay grade. There are many chapters in Dave's life, and given the constraints of this podcast being only an hour long and not 8 hours long, we will only cover one chapter of his life, which is the world of secondaries and him being an LP in emerging managers. But without further ado, Dave, I'm so glad you're here.
I'm not really part of PayPal Mafia. That's the upper echelon. I'm a rank and file villain.
Really? I don't know. At least if we can trust the Wikipedia and just like the number of folks you've kept in your orbit.
I did make the cut for the Wikipedia article, but
yeah,
that took a few years. I originally was added and removed, so I finally stuck.
You are now a tenured member on that Wikipedia article in the PayPal Mafia.
Don't talk about it too much; they might pull me off again.
If any of the Wikipedia admins are watching this or listening to this, keep Dave on. There's a lot he's got there.
Fight Club.
Don't talk about Fight Club. You have a storied career at 500 and backing phenomenal companies like Talkdesk, and your journey across it is well documented already. So the purpose of this conversation, like I mentioned earlier, we'll talk about things that people know you probably a little less for, which is being a limited partner as well as secondaries. So does that sound like a plan?
Sure, that's great.
If I might spark the gunpowder that'll light this conversation, might I suggest we start with Aslan Computing?
Sure, that's way back.
That's way back, early days.
I guess close to, more than 30 years ago now. So it's been a while.
A little birdie out in the tree, actually someone both you and I know, and I think that I believe the person who actually introduced the two of us together. One said the origin of Aslan. I actually didn't know, but it makes a lot of sense in hindsight. The origin of the name Aslan Computing comes from the world of Narnia. So I'm wondering how that inspiration came to be.
They were some books I read when I was growing up, and really big fans of the Chronicles of Narnia. I guess I didn't understand all the Christian allegory behind that, so that's not why I called the company Aslan Computing. But I guess I'm a Leo, so there's a lion in it, and it was just an interesting book about a young boy growing up, and so I think I read the books probably when I was less than 10 or something like that, and kind of stuck with me. So that was just but we also. I guess there was a reason I wanted to start a company with the letter A, so it just showed up in the ordering early. and then later when we started 500, we also kind of did that just because numbers tend to be ordered before letters. So I didn't start a company called Aardvark Computing or 0001 Computing, but those are kind of the same ideas I was going after there. Anyway, it was something different, so that was fun.
Right. I wonder if that's the same reason that there are firms like 01 Advisors and, for ranking purposes.
Yes.
So speaking of Aslan and all that, Could you walk us through, because this was your, if I remember correctly, like your first foray into entrepreneurship. What was that like, and what was the kind of origin point that inspired you to start a business?
Well, I think I kind of fell into it in a way. I had been doing some consulting for a company where I was actually hired by a company that was a consulting company, and I spent a couple years there. And this was probably, I guess, it was in my early mid 20s. I had just come out to the Bay Area not too long before that in '89, and was doing mostly database consulting and some software development, building applications in SQL Server backends and I guess Power Builder and other Windows-based client front ends. But it was kind of my first, and I started out doing just independent consulting for a couple of years, and then gradually went from like 2 to 20 people. But I didn't have any background in business or finance, really not even in marketing at that time. So I was mostly just a nerdy engineer who started, I kind of didn't want to work for somebody else. I kind of wanted to work for myself. And then we kind of got a big project that was, I guess, consulting under Microsoft Consulting or and working with Intel. And that was kind of the big project that allowed us to kind of hire a few people and turn that into a small company. But for the most part, we were a consulting company that did tech, software development, some networking, and then kind of the early days of internet. We started doing some internet consulting, I guess, around 1993 or 94, which was probably right when websites were first coming out, in fact. So in fact, I think we did some consulting work for Netscape when they were just going public. I remember actually sitting in the lobby of Netscape the day they went public. I think that was 95 or 96. So kind of early days. And we did some e-commerce consulting later, I think, for Intuit and for a few other companies. But anyway, it was kind of a roller coaster. I really didn't know what the fuck I was doing. I learned a lot about a lot. I guess particularly about managing people, doing marketing and sales, and doing business and finance. I started to know how to code and do how to do small team management, but all that other stuff about running a business and running a company and managing people and sales, all that I really had to learn on the fly. And in general, usually I would learn it by fucking up first. In fact,
We are
that's
a product of our scar tissue.
one of my favorite phrases. Anything worth doing is worth fucking up the first time. Hopefully, you don't keep fucking it up.
But at least once. At least once.
Well, there's nothing to teach you how to learn something if you don't do it right, and particularly when you're trying to run a company, you really have to figure things out. Otherwise, you're not going to make payroll,
Oh yeah.
which almost happened a few times.
Well, I know in doing like and like in the prep work leading up to this conversation, something that you kind of had in the notes was like you almost went bankrupt a few times or several times, at least in
Definitely,
your words.
yeah,
Um,
more than once. I ran up over $100,000 in credit card debt on 11 different credit cards. Not the best way to finance a company.
Holy cow.
More than once, I used credit cards to make payroll. We never missed a payroll. We were late on a couple of payrolls a little bit, but I think in running the business for at least, I don't remember how long between when we started and got acquired was probably roughly 3 years, something like that.
Uh-huh.
Maybe 4 years. I'm not quite sure. But yeah, it was an interesting ride. Anyway, we almost went out of business multiple times. We did eventually get acquired for a relatively small amount, less than $1 million, but we did get acquired. Yeah, it was just one of those things where I wouldn't call it a great success by any means. In fact, I was sort of more like avoiding striking out by stealing first base. But it definitely was a really useful experience to learn about running a business and you know kind of basic skills in managing people, managing myself, figuring out how to do finance and accounting, and figuring out how to do marketing, which I kind of think is kind of a strength these days, but at the time I was still learning how to do that. And
Yeah.
Yeah, it's kind of funny because when we were running that company, I remember giving this talk. It was like one of the first times I'd done public speaking, and I was like so nervous and I had so much anxiety. And there was like maybe 7 people in the room. I'm not kidding. It was less than 10 people.
Where was
And I
that?
was so stressed out about it. Some Microsoft office where I was talking about an internet server that Microsoft had just come out with. And I really didn't even know it very well myself. So I was trying to explain something that I didn't understand very well, which was why I was nervous. Um, but I had not done hardly any public speaking, and obviously fast forward 10, 20, 30 years later, I've done a lot of public speaking to like thousands of people, and that's not really something I ever worry about. But at the time, I was so stressed out and nervous about speaking to 7 people.
Hey, it
So
happens. It
there's
was your
really
first
some
foray
things
into
that
it.
change when you go. Yeah, exactly. So it was, I wouldn't say it was a complete failure. It was a modestly small success, but it was really useful to kind of just get a first, you know, I guess in the trenches experience of running a business. Not like the experience you go to a business school to learn a business, but to run a business.
Yeah. Yeah.
And at our height, I think we were about 20 people, 2 million in revenue. When we got acquired, we were sort of less than 10. So it wasn't a great acquisition, but we did make a little bit of money, and it was a very useful experience to learn about running a business. Although I probably wish I'd learned it in 2 or 3 years instead of 5 or 6.
I'm curious if we were to canonize that chapter of your life into a time capsule, what would be the one lesson you would take away from that chapter?
We only raised a little bit of money from friends and family. I think maybe 25 or $30,000, but we had an offer from someone to, I think it was raise 250,000 on maybe $1 million valuation, and I knew nothing about venture capital at the time, and I was really scared of taking money from someone. I thought, I might lose control, or all kinds of. I mean, these are somewhat rational fears, but still probably in hindsight, I should have taken the money. But might have gone, either way. But I think it was something I didn't understand very well when I was running that company. And I think that probably fueled a lot of my interest in venture capital thereafter. And most people don't raise capital for a consulting company anyway. So it wasn't a traditional startup in that sense. But that was probably the thing that I didn't do that sort of, sparked an interest in venture capital later.
If I were to take a little left turn over here, one of the things I found out, and I will say this podcast is probably the best excuse to do homework on a friend. And one of the things I found, I know. So one of the things I unearthed, probably this is like a video, I don't know, probably almost a decade back, if not at least a decade back, which was when you were at Simply Hired. And I know. We're going back into the archives here. But I was like, it was too interesting for me not to ask about it, which was you spent a lot of time crafting funny error messages.
Oh yeah, actually yes. That was probably one of the things I was most proud of at that company. I was only there for about a year and a half, and took a long time for them to find an exit, but it was it was a pretty decent exit. But I kind of helped come up with the initial voice and branding for. Well, it was a search engine for jobs, and so you know you can do anything you want with sort of providing error messages. So we just decided to make it sort of fun and interesting. And I think at the time that was sort of a unusual approach to sort of building a search engine that would sort of provide funny error message responses.
I will say nowadays it's less rare, but it still sits in the territory of uncommon that sometimes you just get the error 404 message and it's just a dead end and that's all there is to it. These days, people have started using that more of a marketing tactic and a brand building opportunity. But I think you were early days into that. And the reason I point that out is because that ends up becoming really reflective over the content in which you put out today, and kind of like, I've thoroughly enjoyed reading some of your blog posts as well. And
I like to have fun, and I try not to take myself too seriously or anybody else.
speaking of blog posts, by the way, and this happened to be a very accidental kind of like transition, but one of the blog posts you wrote was this blog post, if I remember correctly, back in like '08. I know it's a while back. Fear is the mind killer of the Silicon
Oh
Valley
yeah,
entrepreneur. You remember that? Remember
yeah.
that?
I
Um,
definitely remember that.
and so I'm actually really
That was
curious.
that was during the downturn of 2008.
Yeah, strictly in the downturn. It was so aptly written, and the reason I bring that up again is just because I think we've gone through and is currently going through a similar chapter in in how people are thinking about the investing game and startups and all that. And so as someone who once wanted to call 500 startups Fear Factory, to in '08 writing that blog post called Fear is the mind killer of the Silicon Valley entrepreneur, and we must be Muad'Dib, not Clark Kent, which actually is quite prescient, not only from a macroeconomic perspective today, but also from a pop culture perspective, as we sit waiting as a society, waiting for Denis Villeneuve's like Dune 3 or Dune Messiah. What are the fears and underappreciated risks of investing in secondaries that people don't talk much about today?
Yeah. Well, I think the point that I was making at the time was like everybody was really, bitching and moaning about, it being a tough time to raise capital and do startups. And I had been through the 2001, downturn, which was way worse than 2008, at least in hindsight. But, the reality is, and it's true today, even more so today, it's probably never been a better time to do a startup, at least in terms of availability of capital and number of people online and access to tools and technologies. And so anybody kind of bitching about a downturn, I always like, Jesus Christ, what are you bitching about? It's better than it was 5 years ago. It's certainly better than it was 10 years ago.
Right.
And so, those same things are very much true. Like I think recently everybody's like, oh, we're down to the amount of venture capital that was deployed in 2017. Oh, horrors, right? In 2017, we were all like, oh my God, this is so great. There's so much money. And now we're like, 5 years, I guess, sorry, 7 years later, we're like bitching about not having as much money. Like, yeah, last time that wasn't really that bad. So, like, why are you bitching?
Right.
But
I think it's a
I
point of
guess,
comparison.
right. So, anyway, I think the Valley is where startups happen and people have to hustle, and probably half the time things are going up and half the time things are going down. And, it's okay. Don't bitch about it too much.
Mm-hmm.
But applying that to secondaries, I guess your question was kind of like, what's um,
What are the fears and underappreciated risks for kind of
fears?
investing? Yeah.
Well, I think
And ask that as a very much of a rookie.
yeah. So the thing that most people just don't understand about secondaries is whatever the value of the thing you think you have on paper, the value of the secondary market is usually going to be less.
Mm-hmm, mm-hmm.
And that's generally because you're translating an illiquid asset to a liquid asset, cash. And so there's a cost to doing that. There's a risk for the person holding the asset because now they're holding the illiquid asset. And with the exception of maybe some period of time when everything was going up and to the right, you could actually sell secondary at a higher price. Most of the time, you're selling secondary at a discount to the previous round or a discount to what's being reported on paper if we're talking about a fund position. And so, at least when we're talking to sellers, there's a lot of education, which is pretty challenging if the holder of the asset thinks it's worth the same thing on paper, from the recent round, or thinks it should be worth more than that. And we have to talk them off the ledge and say, well, that's probably not the case. It's probably worth less than you think. And particularly with fund secondary, which is a little bit different than company secondary, it's usually worth a lot less just because there are very few buyers for fund secondary. And it's harder to turn around and flip that to somebody else. So I think that's the biggest issue, is just people don't understand that there's a huge discount for illiquidity and there's a huge discount for a lack of buyers. And in general, the secondary market is pretty inefficient, although it's becoming more efficient over time, particularly for company secondary and for big names like maybe SpaceX or Stripe or Canva. There is more interest in those names. But still, in general, holding an illiquid asset is tough.
I imagine it's the kind of the bank heuristic where it's like, if you when you want a loan, the bank doesn't want to give you a loan. When you don't want a loan, the bank would love to give you a loan, kind of thing. Where in the world of secondaries, it's like, if you want to sell, there are probably not that many buyers. If you don't want to sell and you're like, this is going to be really big, everyone wants to buy.
Well, I think it's somewhat that, but I also think it's just people look at a number that's reported on paper as if that's cash. And
Gotcha.
it's not.
Yeah.
It's an illiquid asset. And there may be a market for that asset if it's a single company that has, probably at least 50 to 100 million in revenue and it's in demand by other people.
Mm-hmm.
But if it's not a company with a minimum amount of revenue and interest from buyers, it's probably a lot less liquid than people think. And the less liquid it is, the bigger the discount is. If you're sort of further away from a financing round, there's more uncertainty because you don't know if the company's been doing well or not well since that financing round. And so anyway, there's just a lot of things about it that make it very fuzzy and different from, let's say, public equities. So people think about public equities kind of the same way they think about cash, and they're not wrong because public equities usually are liquid immediately, right? I can hold a position, sell it, and theoretically, within a day or maybe 2 or 3 days to take for the trade to settle, you have cash. That's not true with most secondary positions. Even when you're doing company secondary, that might take a little while. But if you're doing portfolio secondary, fund secondary, it may take months to line up a transaction. In some cases, there may not be any buyers at all, and you can't even do a transaction.
Yeah. That makes a lot of sense. And I'll be completely honest here. These are deeper waters that I'm qualified to wade in on. But one of the things that kind of you put down in the notes that is worth talking about, at least in the form of pricing secondaries, is the idea of like a 3-bucket method. And
Yep.
if you want to take it from there, because once again, I while being English, a lot of this conceptually is Klingon to me, where I've allocated most of my calories towards primaries and kind of like venture capital as a whole. But what is the 3-bucket method, and how does one think about it?
I guess I could say secondaries is a dish best served cold. Well, so when I talk about 3-bucket method, what we are really talking about there is kind of winners, losers, and tweeners.
Okay.
And, to use the horse metaphor, I guess we would say unicorns, centaurs, and horses, right? And so unicorns, whether they're actually worth $1 billion or more, people tend to use that kind of as a proxy for companies that could go public. Centaurs, which I think is maybe a term I came up with. I'm not sure I'm going to take credit for that uniquely, but the idea was a company that's worth $100 million. And so those companies probably have some kind of exit, maybe not an IPO, might be an acquisition, but they're probably not complete zeros. And then horses, which are the least magical of those 3 creatures that we talked about. And these are usually companies that are worth less than 100 million, probably, companies that are less than 10, 20 million in revenue, maybe, less than 20, 30, 40 people. And there's no guarantee you're going to get an exit from those companies, right? So when we look at a portfolio, particularly ones that we are thinking about buying, we usually want to see that there's at least one company that's, got potential for being a unicorn or an IPO, probably has at least 50 to 100 million in revenue and some growth and is headed towards a very positive outcome. And that's what we usually anchor the pricing around. Like, okay, might be that's 40, 50, 60% of the overall portfolio. It might be more than one company, but in many cases, it's just one company. And that's where we sort of say, okay, well, we're pretty sure we're going to get an exit at least from that company. Then there's another set of companies where we're like, okay, they may not be an IPO, but they look like they're worth something and they're doing some amount of growth in revenue. And we think there's a non-zero exit, right? And then there's a third group where like, okay, these aren't big enough to guarantee any kind of exit. They might get to something, but probably we're going to discount that to zero or close to zero. And so when we look at those three kinds of companies, usually it's a measure of where they are in revenue and growth, and to some extent maybe profitability, and where we think they're going to be within a 3 to 5 year horizon.
In terms of where you think they're going to be in a 3 to 5 year horizon, is there a smart way to think about that, or is it like if you can play like
Well,
make something more concrete for our audience and for myself, like how would
sure.
one think about that?
I guess if we're talking about a company that might be in SaaS, and we look at public companies that are SaaS companies, a typical minimum revenue requirement for those companies probably has been in the $200 to $300 million revenue range and up. And these days often is like $1 billion in revenue and up. So we would probably want to see a company ideally at the current time is 50 to 100 million in revenue and can get to maybe 300 million in revenue within 5 years. That's generally what we're thinking about as okay, that's going to get to an exit. And that can happen faster or slower depending on whether, hey, it might be a $50 million company that's growing at 200, 300% per year, or it could be a $150 million company growing at 30, 40% per year. And the growth rates might change, profitability might improve or decay. There could be a lot of other factors going on, but in general, we're trying to say, okay, given where it's at right now, we can see a reasonable likelihood of an IPO or worst case, a large exit by an acquirer within 3 to 5 years. And we don't really want to go much more than 4 or 5 years. That's part of our particular fund thesis and strategy, because we're trying to return at least a significant amount of capital in the first 4 or 5 years, at least 1x for us. But we want to see a path to an exit that's pretty short, at least from a venture perspective. And if you look at most IPOs in venture, they tend to be on a 10-year or more horizon. I think at least a couple of years ago, 9 years was median time to public IPO. I think now it's probably closer to maybe 10 to 12 years.
There was an article that we shared between the two of us, and I think you also shared publicly, which is a piece by Endeavor, which is like the time it takes to IPO in an emerging market versus like an emerged market. And I think in an emerging market, it was like 5.5 years, if I remember reading that right. Our audience can correct me on the numbers if I'm off there, but
could be depending on the market. There's a lower IPO requirements in markets like, let's say, Japan or Saudi Arabia. Certainly, Australia has a very, very small, revenue requirement. I'm not even sure they have a specific revenue requirement. But a lot of non-US markets, the size of the company might be substantially smaller, and thus the path to liquidity might be shorter. But at least for US markets and what most people think about, people tend to think about 10-year time horizons for IPO.
I'm just going to ask, I'm going to fire out a bunch of questions, and you feel free to let me know that this is just too rookie and too my naivete is speaking through these questions. In the world of making kind of primary fund investments, a lot of things we think about in a conversation you and I have had offline is the world of fund returners. And for thinking through what is the likelihood of a fund returner? It's got to return at least obviously 1x the fund, and going back to Mike Maple's dictum, a fund size is your strategy. When you're thinking about secondaries, and you're thinking about unicorns, centaurs, horses kind of thing, how much of this fund returning concept or calculus actually bakes its way into your own fund and when you're acquiring stakes in others?
Well, we do think about portfolio models a lot. I would say I think that quote is very much on target. I think that's often quoted by a lot of people. Your fund size is your strategy. I will say, with 500 startups, that wasn't exactly the same thing, just because we had very, very large portfolios. So usually what I think he meant by that is if you have a smaller fund, you don't need quite as big of an exit in your companies to have a fund returner. Whereas if you have $1 billion funds, you really need companies that are exiting at 10 billion or more to make that work, assuming you own 10 to 20% at maturity. We use this to describe sort of the trajectory of typically a seed fund over time. And probably for a lot of smaller micro VC funds that might start out, let's say, between 10 to 50 million in size, they're probably investing in 30 or 40 companies. A few might invest in 50 to 100, but typically people will invest in around 30 to 40 companies at seed or pre-seed. And usually we would guess 30 to 50% of those might make it to Series A. Some people might even have better than 50%. But typically we might see, anywhere from a quarter to half. And then from A to B and from B to C, it's typically about half. Again, could be more or less that make it from one stage to the next.
Mm-hmm.
And so if you think about a portfolio that starts with maybe 30 companies at seed, maybe you get 15 of them to Series A, maybe get 7 to Series B if you're lucky. You might see 3 or more of them that get to some kind of large exit that's $100 million or up, and you might have 1 or more that get to an IPO.
Mm-hmm.
And a few people might have more than that, but it's not that common for people to get more than 1 or 2 IPOs out of a portfolio of 30 companies, and sometimes people get 0. But regardless of what happens to any specific company, usually the case is just one of the companies is going to grow faster and bigger than most of the rest. It's unlikely that 2 companies will end up being the same equal size. Just generally speaking, one is usually bigger than the other. And so the closer you get to the end of a fund, and although most funds are structured as 10 to 12-year vehicles, they typically these days are taking more like 15 years and sometimes even longer than 15 years. But you'll usually see a power law distribution starting to happen around year 7, 8, 9, where one company starts to outpace the rest. And in this diagram, that one company that's sort of at Series D around year 8 is, in that picture, maybe 50% or 60% of that portfolio value.
Mm-hmm.
And so, generally speaking, the closer you get to the end of a fund, the more it looks like one company is the majority of the value. When you're in the early stages of the fund, let's say the first 3, 4, 5 years, you're making a lot of bets. Most of them aren't going to work. And so they'll eventually get written down or written off to 0. And you might have a few winners, but those winners are still relatively small in size until they get to maybe year 5, 6, 7, right?
Yeah.
And so it's just really hard to evaluate these portfolios in the early years because you don't know what's going to happen. You don't know which one's growing faster, and they may figure a few things out or not. But by around year 5, 6, 7, and certainly by year 8, 9, 10, you can really start to see the shape of the portfolio. You can see which companies are the outliers. Usually 1 or 2 companies will tend to separate themselves from the rest of the pack. And those are probably, again, the biggest companies, the ones with the most value. And that's kind of what we look at for underwriting those core assets in that unicorn bucket that we talked about.
And I'm curious from an LP angle, when does an LP start considering fund secondaries? When do they start coming to you? Do they come to you in like year 4, 5, 6? Like, I
Right.
assume it's not year 9 or 10, or maybe it is year 9 or 10. But when do they?
Well, it's kind of a function of how patient they are and what's going on in their life.
Yeah.
It's not really so much based on the assets in the fund. A lot of people think that people start selling stuff whenever things aren't working. Like the question we get a lot of times is like, well, why would someone sell things that are doing well, right? And if we're talking about institutional investors and institutional LPs, the answer is they probably won't. They probably are not going to sell things that are doing well. They're long-term patient investors. They have a 10, 15, 20-year investment horizon. They're hired to manage portfolios over 10, 20 years. So absent some really crazy big, downturn event like 2008 or 2001, they're probably not going to sell their winners. Maybe if they get to the end of their own fund life, they might have to start thinking about liquidity.
Yeah.
But for non-institutional LPs, and here we're talking about individual high net worth people, or not so high net worth people. We're talking about family offices. In general, they might have between 100 million to $1 billion or more overall net worth, but they might have a 5 to 10% allocation to venture capital, maybe even 10, 20, 30% allocation to alternative assets. And then corporate investors. And so individuals, family offices, and corporates, for a variety of reasons, might need to sell or want to sell before the end of the fund life. And so for an individual, could be you're sending kids to college, you're buying a house or some real estate, could be a medical emergency. If you're a family office, it could be you're going through restructuring of the family. That might be due to death, divorce, retirement. You could be trying to cycle out of one set of assets into a different or new shiny set of objects. And if you're a corporate investor, you might get into a certain number of companies or venture funds because of strategic reasons for your business. And maybe 5 years later, 10 years later, that changes. You might hire a new CFO or a new CEO. Could be that, hey, 10 years ago, I don't know, virtual reality was really interesting. Now maybe electric vehicles are really interesting. And so as their corporate strategies change, they might, buy into or sell out of different venture company investments or fund investments. But the reality is just that given whatever market conditions and whatever financial liquidity needs these investors have, for anybody, there might be good reasons that they're selling that don't have anything to do with the company. They just might need cash or might want cash. And what they don't realize is, hey, it's a lot harder to sell an illiquid asset that's not public than it is a public stock.
Yeah.
And a lot of people jump into both companies and venture capital funds not realizing how much illiquidity is a real issue for the asset class. Particularly at the fund level, it's really hard to unload a fund position or sell a fund position. So there are some challenges with companies developed based on whether the company is a certain size, whether there's interesting number of buyers for that company. But if you have a company like Stripe or SpaceX or, in the past, maybe Palantir or Airbnb, there's probably a lot of people who want to buy that stock, even if it's not public,
Right.
because it's big and it's well known and it, appears to be doing very well. If you're talking about a company that's maybe at, Series A or B, has less than 10 million in revenue, less than 20 million in revenue, that's not really on very many people's radars to buy. That company's probably still a long way away from a public exit. It may never get to a public exit. And so it's harder to establish a market for that company's shares. And so as a seller, that's a tougher, story. Same thing for a fund investor. There might be one company within the fund that's doing well, but there may be a lot of other companies that aren't doing well, or it's not clear what the value is. Somebody might want to buy the individual company's position, but not the entire portfolio. And you as an LP can't pick and choose which assets you're selling. You just own a proportional strip of the entire fund position. And so again, that's a difficult transaction. There's not as many buyers usually for those fund assets, particularly if you're in the early years of a fund.
There's so much that's going on in my noggin right now, which is really good because that means I need to rewatch this episode to help myself learn. And my fingers can't write nearly as quickly as the words that are coming out of your mouth.
Well, let's just keep a high level sort of story going on here. I think if we look at industries like private equity, secondaries have been around for a long time. That's a
Yeah.
very established market. A lot of folks in New York and London handle that business. These are huge firms. Lexington Capital, I believe, raised a $22 billion single fund. That's $22 billion.
Holy cow.
Collar Capital a few years ago raised at least a $10 or $15 billion fund. So and the individual fund secondary transactions could be hundreds of millions, maybe even single digit billions of dollars. When we talk about venture capital secondary, that's been around for some period of time. And certainly there are established firms, Industry Ventures, Stepstone, which have been around for a while. Most of their activity probably isn't always at the fund level. A lot of it is at the company level. And most of what people think about when they think about secondaries and venture capital is company shares. But in the last few years, we're starting to see more portfolio secondary. And right now, that's a big issue. So for a lot of people that got into venture who weren't institutional investors, let's say smaller investors in micro VCs and the micro VCs themselves, they probably weren't very familiar with how long venture capital takes. And maybe some of them, 5, 6, 7 years in, have a need for capital or liquidity. And then they find out, oh gosh, this is a much more difficult transaction to handle for selling, particularly at the fund level. And so when we're going through a downturn and there hasn't been a lot of IPOs for the last couple of years, all of a sudden a lot of people are experiencing liquidity challenges for many reasons. And for the fund managers, they probably have had an environment where everything has been going up and to the right for maybe even the last 10 years, up until a few years ago. And they might have some great performance in paper gains, but not a lot of returns or what we call DPI or distributions, right? And so the prevailing trend that we're experiencing in the market right now, because there haven't been very many IPOs, is people are starting to look for liquidity. They're trying to figure out how do they do that, either on marketplaces that buy and sell company secondary, or through brokers, or through people that buy fund positions. And for LPs, they might want to sell a portion or the entirety of their position. For general partners, they might have this issue where they're trying to show DPI or distributions to be able to, satisfy their investors, but also to be able to raise their next fund. And that's a big issue on a lot of LPs' minds is, hey, how did you do with your previous funds? You're maybe started 3, 4, 5 years ago. Have you had any exits? Have you had any distributions? Usually you don't see a lot of distributions until, after year 5, and perhaps not even until year 7 to 10. But a lot of people are trying to figure out how can they generate DPI or generate distributions in the absence of an active IPO market. And that's where, firms like ours and others that buy secondary interest from LPs and sometimes from GPs come in.
How does that conversation usually go? In the sense that, let's say someone like I'm curious. I want to be a fly
There's a
on the
lot of
wall here.
education.
There's a lot of okay, I imagine so. So like let's say a family office comes to you, is like, hey, you know what? We have an inflection point in kind of the family, and things have gotten changed. We need some secondaries. They come to you. They want to sell a secondary in Fund A. How, are those normal kinds of conversations, and how far into the conversation do you start looping in the GP of Fund A that you want to get secondaries from, and how does that conversation go?
Right.
Because I imagine in Fund A, or like just any fund, GPs like picking their LPs, and all of a sudden there's a new person or entity on the cap equivalent of a cap table LP base, and they're like, I don't know what to do with that kind of thing. So like, if you can walk us through that, what
Right.
does that look like?
Well, it's a kind of asymmetric situation. People selling fund secondary, they probably don't do that very often.
Yeah.
It's our business. That's what we do on a daily basis. But maybe similar to people who buy and sell a home, you don't do that very often. It might, in fact, some people might only do it once in their life.
Yeah.
But they certainly are not very experienced with the situation, and so there's a lot of education we have to, talk and explain to people about, probably the biggest issue is what is the asset worth, and they may be looking at a report from either the last round valuation of a company or the last quarterly report from the general partner of a fund. And a lot of times people just tend to think that, oh, it's worth exactly what's in that report. That number that I see is how much I have. And again, that's not really true, because we're talking about an illiquid asset. And so it's not the same value as if it were a public equity or public stock. You could probably sell it at pretty close to what the reported price is, because there's a lot of trading activity in public equities.
Mm-hmm.
In illiquid assets, there may be some trading in that asset if it's a large, well-known, private company. But generally speaking, there's probably not very many people buying and selling positions in most private companies. And certainly in funds, there's very little activity usually in funds. And that activity has to be approved by the general partner of the fund. So if an LP wants to sell their position to someone like us or anybody else, that transaction usually has to be approved by the general partner of the fund. Sometimes there might even be a right of first refusal to other LPs in the fund or the VC themselves. And so you're right. When we talk to an LP, we usually ask, hey, have you expressed an interest with the general partner of the fund that you might want to sell, and are they open to someone else buying the position? So that's one of the first questions that we ask. Another question that we ask is usually, is there anything in the fund that's working? And, again, we're kind of looking at that, unicorn, centaur, horse kind of triage. And we kind of want to know, is there at least one thing that is working in that portfolio? And that's kind of a high level screen that we'll do before we start doing really much due diligence on the portfolio. But then we'll, if we think that there's some interesting things to buy there and the LP has permission to sell, then we might start doing a little bit of due diligence on the core assets that make up the majority of the value of the portfolio. And that might take a few weeks to do some analysis and underwriting. There might be a little bit more time to figure out a negotiation with the seller, what the price is going to be, and then we again have to get approval. Unless we're doing a forward contract or something that might not involve the actual sale of the asset, we're probably going to want to talk to the general partner both to get their approval as well as to maybe get their insights and additional information on some of the companies and how they think about valuation policy and governance.
And how often does it happen where let's an LP, let's say a family office wants to sell their stake in a fund, and GPs say yes? Or like, how often do GPs say no, and how often do GPs go like, "Hey, here's the right of first refusal to all the other LPs," and how often do you spend all that work with education, working with the family office, and the deal just falls flat because right of first refusal to all the other LPs?
Right. I don't know that happens that often. For larger funds that are more established and for funds that are doing well, there may be a ready buyer. There might be other LPs in the fund who will pick up that position.
Mm-hmm.
The general partner themselves might buy the position, although that has a little bit of complication sometimes. But at least for a lot of micro VCs, sorry, you had a question?
Why is that complicated? Like if a GP buys like
Well,
that LP stake, so to speak.
let's just say that the GP might report the value of the asset as $3,
Mm-hmm.
and at least in the current market environment, probably a lot of those valuations are from 2020 or 21, and they've probably come down quite a bit, but they
Yeah.
might not be marked down in those portfolios. So let's say that we think the asset's worth 50 cents on the dollar, and let's just suppose that the general partner said, "Well, we're going to buy it for 50 cents." Whatever that price is, it's probably not $1, and so there might have to be some kind of disclosure event. Hey, they might need to tell the rest of their LP base they're buying that asset. That's probably dependent upon their limited partner agreement. They might have to offer it to their other limited partners, depending on how that LPA is written. But regardless, even if they buy it or somebody else buys it, the fact that it's at a different number than what they're reporting might cause some challenging discussions, let's just say. If a
That's
third
fair.
party buys it at a different value than what the general partner is reporting, well, that's the market, right? But
Right.
if the general partner buys it at a different position than how they're valuing it, some of the LPs might say, well, hey, why did you buy it at such a significant discount to the number that you're reporting?
Gotcha. And is that later then reflected on like quarterly report in the next quarter of like, this is now the price of the share, like across the board?
Well, now we're getting into an accounting discussion.
Yeah.
And
So,
again,
first of all, this
just
is not
because there's a
accounting
price,
advice, not legal advice, but this is me asking out of personal curiosity and for entertainment,
right?
educational purposes only.
Again, it might depend on who's doing that valuation and an auditor's review of that. But a secondary market price is not necessarily a hard valuation for the company. Obviously, if there is a lot of people trading in that company, that could be perceived as a market price because there are a lot of buyers and sellers. If it's a very lightly traded or infrequently traded company, it could be more reflective of the need of the seller, not the value of the company. And so, just because there's a secondary trade that happened at 50 cents doesn't mean the company is worth 50 cents. It might be worth $1, still worth $1. But certainly if the same party who is, managing the portfolio is buying it at a different price than what they're reporting it, that could create some interesting complications in, how they manage reporting to their people. It doesn't mean it wouldn't happen. I mean, still there's, clearly a value to an illiquid asset being converted to cash. But it might raise some questions that general partner doesn't want to have to deal with. So usually what happens is either they'll find another buyer who is an existing LP. They might have a process for buying it internally and managing that. But often they'll be okay with a third party buying it as long as that third party is known to them and is acceptable. LP isn't going to be a squeaky wheel, right? And so sometimes the existing LP who's needing cash is a squeakier wheel than somebody else coming in. So this isn't usually the general partner's problem to provide liquidity, but they would probably prefer an LP that's not going to be constantly asking for liquidity and is more, willing to sort of be loyal to the fund and hang in there for the long term. If it's a larger fund with a more established LP base, there might be an internal buyer already ready
Okay.
for that. If it's a smaller fund that's started in the last 5 to 10 years, a lot of those LPs aren't usually going to pick up those positions, and the GP themselves is probably not going to pick up the position. So at least for a lot of the micro VCs that we end up engaging with, usually we get approval from them to do the transaction without any problems.
And so if I were to help define what you mentioned earlier, which is squeaky wheel, is an example of, just out of pure curiosity, right? Like, is an example of a squeaky wheel as an LP coming in saying, hey, you know what? I want to add an additional side letter to my purchase of the LP stake, or like, what do you mean by
No,
squeaky
that's
wheel?
usually just somebody who wants cash.
Oh, okay.
Or, could be other things that are going on that's, I would say at any given point might be anywhere from 10 to 20% of the LP base needs cash or liquidity, not institutional LPs, but again, the groups that we
Smaller
talked
side.
about.
Yeah.
And just a lot of them don't realize how long venture capital takes. And, 7 years in, they might be, hey, my portfolio looks like it's 3x on paper. Where's the money? But it might not be, till year 7 to 10 that you start seeing any distributions. Might even be year 10 or longer before you get back to 1x.
Right.
And so that's an event that most LPs will go through in their first fund. Once they're in it for 5 to 10 years, they'll have that wake up moment and like, oh, I need some cash. Oh, wait, it's not so easy to get cash.
Right.
And sometimes they'll be talking to the GP and asking, hey, are we going to get liquidity this quarter? Hey, how about this quarter? And at that point, I think the general partners might say, well, obviously this person does not really understand how long-term the asset class takes, and we might want to find somebody else to take over that position.
Gotcha.
It's not like this is like everybody in the fund, but I would say at any given point in the fund, at least for funds that are 5 to 7 years old, probably some number of LPs that fall into that category. And so it's not really the general partner's problem to find cash for them, but they'd probably prefer to just, help that person find some cash and have a less noisy LP that they have to work with going forward.
The word on the street right now is that funds these days are more 15-year funds than they are 10-year funds. And,
absolutely.
Right?
That's not news.
I guess that's not news.
Been
Sorry,
happening for a while.
That's not news. But I don't know about you, but like kind of the emerging managers that are pitching to me always pitch it as if their fund is 10 years long with 2 extension years.
Exactly. 10 plus 2, which is another one of the biggest lies that VCs tell.
Right.
It's typically more like 15 years. I would say in some cases 15 to 20 years. But probably what we're really talking about is when is a majority of the economics value of that fund returned. And that probably starts happening around year 10 to 12, but probably doesn't finish happening until around year 15, in some cases, 16, 17, right?
Right. I mean, Fred Wilson's fund one was a 15-year fund, right? That was like if I remember correctly, it was like a 15x fund or something like that. He wrote a blog post on this.
Well, and Fred is probably one of the best investors of all time, USV. I would say I had him as an LP in my first fund at 500, which was really amazing. But even for funds that aren't amazing, I guess I would say, just because most companies take 10 to 12 years to go public, and you have a fund which has multiple positions, you're going to run the fund at least for, until most of those large assets exit, or you might have to restructure if they take longer than 12 years or get approval to extend the fund beyond 12 years. And so if you look at, 500s funds that I managed, the first fund 1 is now about 14 years old. Fund 2 is about 12 years old. We've certainly had, several IPOs and big wins, and those funds have done very well, but there's still companies in the first fund that are illiquid, at least probably 3 more IPOs, I think. Probably be at least, I would guess a couple years, maybe 2 or 3 years before those companies fully exit. Fund 2 has a big winner in Canva, and that's partially liquid for some secondary sales, but they're still planning for an IPO probably in 2025 to 26, depending on what the founders have said. And there's other companies that are going to be taking longer. So at least when we look at these portfolios, for us, it's typically been 15 to 16 years before we see a majority of the big winners exit. And it might be even longer to get all of the big winners to exit.
Speaking of the biggest lie in venture, at least in terms of a timeline scale, like 10 plus 2 years kind of thing,
There's a lot of
there's a lot of them.
them.
Is it better for well, one, it's important for LPs probably just start thinking about funds as just 15-year funds regardless of what you actually see on paper. But two, is it better for GPs these days to pitch the fact that their fund will be 15 years?
It's certainly not better
Okay,
for
sorry, not
GPs to be
more
pitching that they're
transparent.
50 years.
I don't know, transparent. Better might not be the best term here.
More transparent, I think, is probably accurate. And
Okay.
so, again, I think what we're talking about is not that there's a single event where everything is done. That sounds like it's binary, right? What we're really talking about is, when does the fund deliver 1x back? When does the fund deliver 80% of its total value back? And I would say for most VC funds, 1x doesn't usually happen until 8 to 10 years in, and a majority of the economics doesn't happen until 15 years in. And so that's when we say, it's a 15-year fund, we're also saying, and you won't see your initial capital back probably at least at the earliest years 5, 6, 7, but probably more typically around year 7, 8, 9. And so that's one thing that's probably not a great story, for investors in the asset class who don't realize how long it takes. And this is, again, one of the problems we're trying to solve as a venture capital firm that is a much shorter time horizon fund. So kind of 1x back in, let's say, 7 to 10 years. And if you're lucky, 2 to 3x back probably in 13 to 15 years.
Gotcha.
Or longer.
Or longer.
Which is a short way to say venture capital is the world's shittiest asset class. But it's also the best asset class. It was the best of times. It was the worst of times.
Right. Pros and cons of things. One thing you mentioned earlier is as you're looking at these VC secondaries, the time horizons like 3 to 5 years. One thing you also dabble a lot in is like the private.
For us, that's what we're trying to design for.
What
so there's a certain set of constraints in order to achieve that result.
Right. And so those are your parameters per se. And as you're dabbling into like the private equity buyout secondaries, is there a different time horizon for that, or is it similarly 3 to 5 years?
Well, we don't do that. That's much larger investors. Again, when people say the word secondary, it can mean
it's a lot.
People act like secondaries is one thing, and it's actually 100 things. In fact, you could argue that the secondary market is as diverse as the primary market in terms of different sizes, strategies, geographies. But when we're talking about the underlying companies in private equity and buyout, they tend to be much bigger companies, later stage companies with more revenue and more metrics to look at. And in venture, there may be some companies that have that size and scale that you can, do easy underwriting, or at least do, have some numbers to look at. But there's also usually a long tail of assets that, are not going to get to an exit or not an obvious exit. And there may even be 20, 30, 40% of the portfolio asset value, which is never going to get to an exit. And so it's a much harder underwriting to do. If you have a private equity fund that might have, 4 or 5 remaining assets that are all, I don't know, several $100 million in revenue, billion-dollar valuations, they're probably headed to some kind of an exit.
Right.
There's a number to look at.
Okay.
There might be a few things that don't, make it all the way, but the majority of the assets probably do get to an exit. In venture, it's kind of the opposite. The minority of the investments get to an exit, certainly a minority that get to an IPO, and the majority fail, right? And so when we look at a portfolio in the beginning, we kind of know from our days running 500, we made thousands of investments, 50 to 70% fail completely. We get a small exit from 20 to 30%, small like 2 to 5x, less than $100 million. We get, 10 to 20x exits from maybe, I don't know, somewhere around 10%. And we might get IPOs from single digit percentages, in our case, about 2 to 3%. So it's the minority case that really get to a large public exit, and the majority get to no exit or a smaller exit that's not an IPO. And so underwriting is much more complicated for venture. You have a multi-asset portfolio, but you also have a lot of fuzziness on the details of those smaller assets. typically we write those to zero.
Uh-huh.
You have some tweeners that like, okay, these are going to get to some kind of exit, but we're probably discounting them because we're not sure. And then you have some assets that are like, okay, these are real companies. They've got, substantial revenues, 50 to 100 million and up. They're, very likely to get to an IPO. Great, we'll underwrite those with a higher level of confidence. But then for each of those assets, you're sort of doing, variable discounting, and you're also trying to predict when they're going to get to an exit.
Yeah.
And so again, if they're outside that sort of 3 to 5 year window, it's almost like they're not ever going to get an exit. Maybe you can predict that it will get to an exit in 7 to 10 years. That but that doesn't matter as much, and we're trying to figure out what's going to happen. Most of those assets, at least for us, we want to get an exit within a 5 year horizon or less. Which is to say, there's a lot of art and not a lot of science. there is quite a bit of math, but it's also probability distributions. And a lot of fuzziness around kind of where those companies ends up. That's the big difference between venture capital and private equity or buyout or other less volatile assets, less bigger assets that are easier to look at metrics and real profits.
And so I'm curious, as you're I've spent some time with like endowments and like these institutions when it comes to LPs who have been allocating. So less like a little bit less so in terms of like corporates, family offices, a little bit more individuals actually, just because of my past at On Deck. But one of the things that I've learned from like these endowments, right, is they have these buckets when they say private equity, they mean buyout plus venture capital. Like private equity, it means like both for them. At the same time, like venture is usually like 10-20% versus like private equity is like 70-80% of that larger portfolio altogether.
That's correct.
Yep. And so when I'm not sure what your LP base is for practical per se, but when you have conversations with more institutions that are out there, how do they bucket you? Like, do they bucket you in the venture capital bucket? Because it's not really primaries either. So how do they think about doing that?
Most of our investors to date have been individuals and family offices. Now that we're raising our third fund, we are talking to institutional folks. We're still probably a little bit on the smaller side. We're aiming for a $100 million fund. That's kind of just at the edge of when, a lot of larger institutional folks are looking at funds, but it is our third fund. Venture capital secondary, although it has been around in some form for maybe 10 to 20 years, still a relatively new category, particularly when we're talking about portfolio secondary. And really what we're really talking about is all these micro VC funds that got started in the US maybe 10, 15 years ago, in other parts of the world, 5 to 10 years ago. So it's kind of a new problem to solve. Most of these private equity secondary, their customers are other institutional holders.
Mm-hmm.
And in venture capital, there are some, folks who have institutional, who are institutions who need liquidity. But again, like I said, most of that, it's not really an issue, in the 5 to 10 year horizon. It's an issue maybe at the end of the fund life, or if the fund life is being extended. So there's kind of a new set of problems and customers where you have these non-institutional LPs who are investors in VC funds who are figuring out how long it takes. And you have a whole bunch of micro VCs themselves who are, starting out within their first, let's say 5 to 10 years of their career, and they haven't seen the end of their first fund yet. And so that's usually the group of folks that we're talking to who are our customers, the sellers. When we're talking to institutions about this, a lot of times we're explaining the asset class to them because they've seen secondaries in private equity. They've seen secondary firms like Industry Ventures and Stepstone and maybe Acadian and a few others that have dealt mostly with company secondary. They haven't seen a lot of this, what we call LP secondary, that's non-institutional LPs, and this problem with micro VCs, GPs. So there are a few other people out there doing this, not that many yet, and it's fairly recent. I would say in the last 3 to 5 years or so. Again, a few folks have been at it longer than that, but a lot of the changes that are happening now are really because that wave of micro VCs that came into the market and the wave of non-institutional LPs. A lot of people in the Valley who were like myself, individual angel investors. We all started jumping in, let's say initially maybe 2005 timeframe, first round capital, SV Angel, and a few others, and then that super angel micro VC wave that happened maybe 2008 to 2010 in the US. which was when we started, 500 and a few others, Felicis, Uncorked, and others. But then there became this like massive wave, let's say starting around 2014, 15, 16, and a whole bunch of people jumped into venture capital. And that really, continued until maybe just a few years ago. And so these problems don't really start happening until, let's say, 5-7 years into these VC funds. So it's still kind of a new phenomenon that's been around for maybe a decade or more. But people didn't really see the issue until those funds were 7 to 10 years old. So it's kind of new that you have these non-institutional LPs in funds and emerging managers who have been managing small funds who don't have institutional patience or size and need liquidity. And so that's really kind of what we've been explaining. There's a large problem to be solved here, and the amount of capital available, even from established secondary buyers, is not nearly enough. Particularly in this market, there's 5x, maybe 10x or more the amount of inventory available to buy than there is capital to buy it. And if you look historically at any downturn that happens, usually in the years after the downturn, there's an explosion of secondary firms and capital that come into the market to solve these problems. And that's probably what we're going to be seeing happening over the next 2-3 years, is a lot more secondary firms that establish raising larger funds and new players jumping in to fill that niche in the market.
This is too fascinating. I also know we're running up at time, and we have our curtain call in just a bit. So if you'll allow me to be the bull in the china shop to change the order of operations for our conversation, I should have asked this sooner. But I'd be remiss not to talk about practical VC in and of itself. And the element of practical VC I want to talk about is, I believe when you first started Practical, it was supposed to be a traditional fund-to-fund investing in VCs. And so clearly not that now. And I know this idea was incubated in your mind in 2013, 2014 of like, okay, I want to do a fund-to-fund strategy. And this was like, you were thinking about this while you were still at like 500. Can you walk us through the inflection points of like what it took for you to go from that incubated idea to the secondaries strategy fund it is today?
So you're right. A lot of this was incubated at 500. There were probably 3 strategies that we looked at 500 that were core to what we were doing, that were probably different from other funds in the market or other accelerators. So we had obviously a focus on large portfolios. It's in the name, 500 startups. So our first fund was 265 companies. Our second fund was about 300 companies. Our third fund was almost 700 companies. So we did large portfolios from the very beginning. We were also very global from the very beginning. And in fact, after I left, they changed the name from 500 Startups to 500 Global. So starting as early as 2011, I guess, we were investing in Brazil and India and Mexico. We acquired one of the firms that we invested in that was running a VC fund in Mexico. That became our Latin American team. We started a pretty substantial program in Southeast Asia that was run by Kylie Eng, who I hired. And we also did a similar program in other geographies, probably about 15, 20 different countries around the world. We had team members. So large portfolio, global team. And then the other thing was this sort of like network of funds, or a satellite set of satellite funds. Kind of, we were running our own fund of funds strategy internally. And so we had started about 20 small funds within 500 when I left. And I was kind of thinking about, hey, let's do that from the very beginning. Let's create a micro VC fund of funds. Let's do some education, and let's do some back office platforms. And we really think about it kind of like almost like 500 VC funds. In fact, that was internal code word for a long time, was 500 VCs. And that was where we kind of headed. There's some other folks who are doing that these days. In fact, I would say VC Lab, Dessau Group is one of the firms that we are invested in, actually also in their fund. And Coolwater Capital is another one. And so there are great people
for our end.
So there are great people who are doing those programs where they're helping educate new fund managers and get them started. In fact, we had started teaching a course at Stanford about probably 10 years ago called VC Unlocked. I think I did the first course there in 2013 or 14.
I've actually met many of your students from that class, and they've said it was like one of the best classes that opened doors for them when it came to understanding the VC and LP landscape. So you have good testimonials
Well,
for that class.
that's great. I guess probably a lot of other funds came out of 500. I think there's probably like 20 different VC funds that have now been started outside of 500. Um, but the reason I was mentioning this was I thought we were trying to do it inside the platform of 500, but why not go out and just raise a fund of funds explicitly to invest in emerging managers globally. As I was talking to people about that strategy, I got a lot of pushback from investors about, hey, you're doing this crazy thing. You're investing in rookies, VCs all over the world. That seems kind of risky. It's going to take a long time. I was like, yeah, but the thing I did before was kind of crazy risky, and that ended up working. But I kind of didn't want to spend the next another 10 years of my life trying to prove people that wrong. And we did prove a lot of things at 500, but it took a while. Along the way, I was looking for some liquidity in my carry in my first two funds at 500. They had done pretty well. I kind of needed a little bit of cash to get the new fund off the ground. I wanted to buy a house in Silicon Valley. And so I went around and looked for someone to buy a piece of my carry in my first two funds. And I thought it would be pretty easy because those funds were doing very well. Turns out it wasn't so easy, even in a good market. And so after going through that process, I was able to complete a transaction, take some money off the table. But it was kind of a challenge. And I realized probably a lot of other people have that same issue. And we kind of pivoted the idea of being a micro VC fund of funds into being a secondary firm for micro VC funds. And I think we were kind of scratching our own itch to some extent, but we also saw that it would be faster and easier to prove this model because we have more like a 5-year horizon for liquidity instead of a normal 10 to 15-year horizon for liquidity. So that was kind of the progression of why we pivoted from being a micro VC fund of funds into a secondary buyer. But we also realized, hey, there's this kind of interesting piece of the secondary market, which is not what most people think of. Usually they're thinking about company secondary, where people buy shares from an existing investor or from the founders or people who work for the company. We were realizing, hey, there's an opportunity of equal size buying positions from LPs in a fund and sometimes buying partial liquidity positions from the GPs of a fund. And particularly in the scenarios where we're talking about where they have a great mark on paper, maybe they're up 3x, 4x in 5, 6, 7, 10 years. But they don't have any DPI or distributions yet. And so both of those scenarios were kind of interesting new customers that maybe didn't exist in large scale 10, 15 years ago, but now there's lots of those potential types of customers. And we kind of knew that because we were that customer. We were that emerging GP who was looking for, liquidity distributions. We were LPs in a bunch of other funds and realizing how long that took and wanting to take some money off the table and get some cash back to do other things with. So that, when we were first looking at doing the micro VC fund things, I guess I was looking at it, 2018, 19 timeframe, but we really realized around 2019, 2020, we were going to pivot into this micro VC secondary strategy and really focusing, more on the LP and GP secondary positions as opposed to individual company positions.
It all makes sense. Like I'm seeing the
well, people always say that you should start a business where you know the customer or have been the customer. And in this case, yeah, we definitely were the customer, and we knew a lot of other friends who were LPs and GPs who were also likely customers and were facing the same set of issues. So for us, it was just a pretty natural place to go, build a business. I guess we got started on that about 4 years ago. We kind of dog-footed the project, buying some of our own positions in funds that I managed at 500, but gradually branched out and started doing that with other firms, and it's working pretty well. And I guess because of the recent downturn, there's a lot of people out there who are looking for liquidity, and I guess after the last 4 years or so, it seems like there's a lot of validation for what we're trying to do.
Oh yeah. I wish I could talk to you more about this side of things, and you and I chat offline, actually mostly about primary investments and less so about secondary. So this is
well, we talk about other fund managers and what some of the challenges they have, and how do we know if they're good or not, and what's working, and again, structure and fund models and all kinds of other things.
Oh yeah, I mean, there's this Venn diagram of conversations in which we talk about, and this today's conversation is that Venn diagram where I've personally had very little exposure to. So this has been my secondaries unlocked education, so to speak. And I imagine it is similarly true for a lot of our audience. So as we're kind of in the fourth leg of this relay race, so to speak, I kind of want to I usually take these opportunities to talk about things that kind of showcase the humanness behind LPs and all that, because too often kind of like people look at limited partners and like, oh, that's just like a class of people I need to talk to, and so be it, kind of thing. And so I guess the first question I have here, and I think I found this to be fascinating, which is, as someone who's once interviewed with, was once interviewed by first rounds Josh Kopelman, hoping to get a job and getting rejected, but ended up getting a 100K LP check from him.
Oh yeah.
When you started 500, and equally so, you got another, like, a check from Fred Wilson as well. How has experiences and relationships like the one you have with Josh helped you better appreciate that a no today is not a no forever?
Well, I think in that situation, I often tell people I think Josh wrote me a check so I would just stop nagging him. But he's a friend that I met probably, I don't know, probably close to 20 years ago. But he's one of the best investors in venture capital. I think he's one of the smartest people in venture capital. I was very fortunate to have a few opportunities to talk with people like him and Fred and a few others, to learn as much as I could, because they were 5-10 years ahead of me getting started in venture. And honestly, if Josh had given me a job, 500 may never have happened. I would have jumped at the chance to work at First Round Capital. He was probably the person I really wanted to work for the most. And yeah, one thing led to another. I didn't get a job opportunity to work there, but surprisingly enough, he agreed to invest in my fund. And I was really surprised, because I think I had asked him like 2 or 3 times, and he kind of said no. And then we were kind of getting, I think, to the end of our first close, or something was happening. And I was really surprised he said yes. And I was like, holy shit. Okay, great. And again, was fortunate to have a few conversations with him afterwards, because he was an LP. But he's just a really smart person. I have a ton of respect for Josh and what he's built with First Round. So that was a case, I guess, of a no, a many no's, eventually turning into a yes. But I honestly think he might have just been trying to get rid of me.
I mean, that's a healthy rejection email to give you that check to start a fund, to get quote unquote.
And for anybody else out there who's looking for me to stop bothering them, that's a real easy way for me. Just like write me a check, I will stop bothering you.
Although you've had multiple conversations since then, so it's like, it was stop bothering for a check or an ask of me, but then once you're kind of sitting alongside and also looking at startups together, I feel like we're all friends and comrades here.
A lot of people thought 500 startups was a bad idea for a very long time. So I would say for at least 5 to 7 years, people used to laugh in my face when I told them the name. Nowadays, 14 years later, I think Fund 1 and Fund 2 have done pretty well, and maybe people don't think I'm an idiot these days.
The proof is in the pudding these days, so you can't argue with the numbers that come out. To switch gears a little bit over here, and this is to scratch my own itch, there's a lot of lore that surrounds the PayPal Mafia. And we alluded to this at the very beginning, but a group you're no stranger to, that includes the likes of Peter Thiel, Roelof Botha, Reid Hoffman, Elon Musk, Max Levchin, David Sachs, just to name a few. And I'm curious, and one of the reasons that I believe that the PayPal Mafia is called the PayPal Mafia, not the PayPal alumni, is because the Mafia continues to work together even after leaving PayPal. Let me know if I'm off the mark here. So I'm curious, how often does the PayPal Mafia get together?
I could tell you, but then I'd have to kill you.
Oh, I'm sorry. Well, that's everyone in the audience as well. Maybe I'll click release on this episode before my editor has a chance to look at it.
I will have to be honest that I'm not in the inner tier of the PayPal Mafia. I think that article in Forbes, there's a picture in Forbes or Fortune, I can't remember, a very famous picture where they actually really had people dress up as if they were Mafia members.
I know that. We can find that. We can find that.
I think there were like 13 or 14 people in that picture. So I was not in the Mafia, and I was not in that picture.
You're on Wikipedia.
Well, and this is another story in that I didn't add myself to that group. Somebody else did. But for a while, I was added by other people and then removed by other people. So for at least 3 or 4 years, I was flip-flopping between being in the third tier of PayPal Mafia and not being in the third tier. Anyway, definitely there's a bunch of people there who are super, amazing people who have built both, incredible companies and incredible firms and funds and have done a lot of shit. I don't really feel like I'm in that tier one group and probably not even in the tier two group. But there are some, PayPal was in a really amazing place that generated a lot of, fabulous, funds and companies and people. And I'm really fortunate to have been there for at least a few years. Certainly, I would say Peter and Reed influenced a lot of people to jump in as angel investors. That's probably one of the really formative experiences there. Aside from all the shit that I learned, working at PayPal for 3 years, Peter and Reed were particularly active angel investors in other companies, and that kind of spread to a lot of the other people. I think the first angel investment I made was while I was still working at PayPal, probably around 2002 or three, I think. I'm trying to remember exactly. And then I became a pretty active angel investor in about 10, 15 companies after I left PayPal. And some of that was, from other people that I had worked with at PayPal. I don't know if there's an inner circle that meets more frequently. I mean, clearly, I think Peter and Reed, even though they are, maybe from different political bends, have had a friendship since their days at Stanford. And I don't know if they invest together as much these days, but certainly they did for a while. Folks like Keith and David Sachs and Peter, worked together and also invested together. And even strangely, I think, there's some intrigue around Elon Musk leaving PayPal because of a board coup that happened at one point. But then later, Peter invested in SpaceX, or at least Founders Fund invested in SpaceX. So it's kind of an interesting and complex world, but there's a lot of connections between folks. I occasionally got to go to a few events. Peter threw a reunion at his house, I think 2 years ago, for a 20-year reunion for PayPal employees. And I got to see a whole bunch of people there. There's certainly been a few gatherings that a lot of us have come to, and a small group that I used to work with at PayPal that probably meets on at least an annual basis, sometimes even a quarterly basis for drinks. But I think it's just a network of people who really believe in, a lot of smart people, a lot of people who are active investors, either angels or VCs, and a lot of people who have just built incredible companies and funds. And, again, I got to work at PayPal for a few years. I got started working with Founders Fund before I did 500. But I'm probably not in the tier one group or tier two group, and I'm happy to have been a lower level henchman in the Mafia.
You are extremely humble when you say that, because there's so much.
No, not really, man. Like that top level of folks is pretty amazing. Like, I might feel like, hey, I'm a pretty good athlete, but those guys are at another level.
Nevertheless, you are a professional athlete in many people's books, and that is already a tier before a lot of. On top
Happy
of
to
all
be
us
warming the
laymen out
bench.
here.
Happy to be warming the bench. I'm ready to go, coach. Put me in.
One of the as there's so many things I want to ask, and because I sent you a lot of questions beforehand, but maybe as the last thing, and this is something I found out, I kid you not, yesterday from you. So let me know if this would be of interest to answer. But from creating a TV show called The Bazillion Dollar Club on the Sci-Fi Channel, I know. There's some YouTube trailers out there, so if people are curious, they can go find it. To starting geeks on a plane that took industry experts around the world, what's been the most expensive lesson you've learned when it comes to venture education?
Oh, the most expensive lesson? Not investing in Uber, TransferWise, Carta, or Zapier. Those were the most expensive lessons. those four in particular, because I came really fucking close. Oh, shit.
That's got to be a blog post at some time.
I think you were probably getting at something else, but, as much as I invested in thousands of companies, those 4 or 5 misses were probably what I, think about the most. But oh gosh, I wish I'd done that. What else? Yeah, that TV show is really fucking big waste of time. We shot 6 episodes. One of them aired. We got canceled right after the first episode. So
The trailer is really well done, though. I was watching the trailer, and it's like
it was super fun. Yeah. Anyway, we probably wasted 3 or 4 months of time trying to put that together, and some people have made it work. God bless folks. I think the Drapers have done a TV show. Obviously, Mark Cuban's been fabulously successful with Shark Tank and a few others. But I would advise people who are thinking about doing a television show, just do a few video blog posts first.
Actually,
do some trailers before you invest in a full-fledged TV show.
There's what is David Cohen from Bessemer. He did this like parody of Silicon Valley parody called Bubble Proof, that for those who are not, I think it's like 10 episodes or whatnot. It's like 10 minutes per episode. I kid you not. It's a great, if everyone's ever curious on a parody of Silicon Valley based on insiders alone, and because like David was on the show and Miraco at Floodgate was on the show, and they had a bunch of other folks on the show, and like analysts and associates at that point in time who've grown on to become like partners and at respective firms. But that's like a equivalent of it, like not a fully fledged TV show, still really high production value, but was done on YouTube instead of, as far as I know, instead of any other platform. Although I might be wrong there, please do fact check me. But it's an enjoyable one. It's on YouTube. Anyways, Dave, I've enjoyed every second of this, and this is my Secondaries Unlocked education, and I'm surprised I never asked you sooner about the world of secondaries, because I know that takes so much of your brain space. Anyways, if there was only like one platform out there, I know you're on all the platforms, Twitter, LinkedIn, you name it, kind of thing, and there's this shitification going on with Twitter right now, unfortunately, for better for worse. But like, like where's the best place for people to find you? Is it email, LinkedIn, Twitter? Where do people find you?
Probably right now, I guess I would say, Twitter, LinkedIn are easier places to reach me. I hang out on a lot of different social media platforms and other, areas, but those are probably easiest places.
Okay. And I'm sure people will come to you with asking questions on, tell me about the Uber story, tell me about the Zapier story. And you will have a platform of yourself when you need
mistakes, certainly there, but fortunately we did find a few other big wins at 500, and things have done pretty well there, and hopefully we're on the right track with Practical.
I love the humility. Anyways, Dave, thank you so much, and I've enjoyed every second of this, and hopefully our audience will as well, in terms of kind of the secondaries education part of this. So thank you so much.
Thanks for making time for me, and just remember, we call it Practical Venture Capital because venture capital isn't practical. I guess I could say secondaries is a dish best served cold.
I want to give a special shout out to today's sponsor, Alchemist Accelerator. Backed by the likes of Coastal Ventures, Mayfield, Salesforce, just to name a few, Alchemist is the top B2B startup accelerator that's been around since 2012, backing founders from day one. And if you've been around for 12 years and running laser focused only on one industry, you build this incredible set of flywheels, and positive feedback loop is absolutely insane. We back the best enterprise talent who go on to change the world in which we live in, who then come back to their hometown, coach, and mentor the next generation of world-class enterprise talent. And don't take it just from me. Alchemist has backed the likes of LaunchDarkly, Rigetti, Privacera, MoEngage, FarmWise, just to name a few, many of which who have come back as mentors and coaches for the current classes of Alchemist. If you're curious and want to get more involved in the Alchemist ecosystem, check out alchemistaccelerator.com/superclusters. That's an S at the beginning and S at the end, and we'll include the link in the show notes below. Till next, stay awesome. Hey Superclusters fans, David from Post here, and if you're tuning in from Spotify, Apple Podcasts, or wherever podcasts find your ear, it'd mean the world to me if you left a review. For those from the YouTube universe, let me know if you agree or disagree in the comments, and it'd mean a lot to me if you could share this episode with just one other person who'd get a kick out of today's topics. I'm on the road to publishing to at least 100 episodes of Superclusters, so every comment, question, review helps me make this experience more helpful, exciting, and fun for you. And lastly, I want to share a quick disclaimer. The views expressed in this episode are for informational purposes only and are solely the views of myself and the guest alone. They are not representative of Alchemist Accelerator. None of the views expressed herein constitute legal, investment, business, or tax advice. Any allusions or references to funds or companies are for illustrative purposes only and should not be relied upon as investment recommendations. Consult a professional investment advisor prior to making any investment decisions. And that's all from me. See you on the next.